Did the Fed cause the 2022 inflation crisis? The question nobody wanted to ask. In 2022, inflation hit 9.1%, the highest level in 40 years. Groceries became noticeably more expensive. Rent surged. Gas prices spiked. Everyday Americans felt it immediately. And almost overnight, the narrative was clear. Supply chains, the pandemic, the war in Ukraine. But here's the uncomfortable question. What if inflation didn't just happen? What if it was partially engineered? Not intentionally, not maliciously, but as a side effect of decisions made years earlier. Because when inflation exploded, one institution had already injected trillions into the economy, the Federal Reserve. So the real question is, did the Fed cause the 2022 inflation crisis? Let's break it down. March 2020. Markets were collapsing at record speed. Unemployment surged. Fear spread globally. The Federal Reserve responded aggressively. Rates were cut to zero. Quantitative easing resumed immediately. Trillions of dollars were injected into financial markets. The Fed expanded its balance sheet at unprecedented speed. Liquidity flooded the system. At the same time, Congress passed massive stimulus packages. Checks went directly to households. Businesses received emergency funding. Here's the thing. At that moment, it made sense. The economy was shutting down. Without intervention, we were looking at a depression-level collapse. The Fed acted fast, decisively, and markets stabilized. But stabilization has side effects. When the Fed prints money, it increases reserves in the banking system. When Congress sends checks, it increases consumer spending power. Now combine that with ultra-low interest rates. Borrowing becomes cheap, spending increases, risk-taking rises, asset prices climb. In 2020 and 2021, stock markets surged, housing prices exploded, crypto markets went parabolic. Liquidity was everywhere. And here's where it gets important. At the same time, global supply chains were breaking. Factories shut down, shipping bottlenecks intensified, energy production slowed. So now you had a unique combination: massive demand, restricted supply. That's the formula for inflation. By mid-2021, inflation numbers were rising. At first, the Federal Reserve described it as transitory, temporary, a short-term supply shock. And to be fair, there was logic behind that assumption. Post-pandemic demand spikes often normalize. But inflation didn't fade. It broadened. It moved from used cars to housing, from energy to services, from goods to wages. And once wages start rising in response to inflation, it becomes harder to control because expectations change. Businesses raise prices expecting higher costs. Workers demand higher pay expecting higher prices. Inflation becomes self-reinforcing. This is exactly what happened in the 1970s, and back then the Fed had to slam the brakes. Led by Paul Volcker, interest rates soared above 19%. The recession that followed was painful, but inflation broke. In 2022, the Fed faced a similar dilemma. Here's where nuance matters. Did supply chain disruptions cause inflation? Yes. Did fiscal stimulus boost demand? Yes. Did energy shocks from the war in Ukraine contribute? Absolutely. But here's the uncomfortable part. Would inflation have reached 40-year highs without ultra-loose monetary policy? Probably not. By keeping rates near zero for too long, by continuing asset purchases deep into the recovery, the Fed amplified demand. It didn't create supply shortages, but it intensified the demand side of the equation. And inflation is always a balance between supply and demand. Too much money chasing too few goods. That phrase may sound cliché, but it describes exactly what happened. Here's something else people overlook. When the Fed injects massive liquidity, it doesn't just boost spending, it boosts asset prices. Stocks climb, housing surges. When asset prices rise, people feel wealthier. And when people feel wealthier, they spend more. Economists call this the wealth effect. In 2020 and 2021, markets recovered with incredible speed. Housing markets became ultra-competitive. Low mortgage rates fueled buying frenzies. House prices rose at historic rates. That increase in perceived wealth translated into stronger consumer demand, which fed inflation further. So even indirectly, monetary policy can shape inflation expectations. By 2022, inflation was no longer ignorable. It hit 9.1%, the highest since the early 1980s. The Fed pivoted hard. Under Jerome Powell, interest rates rose at the fastest pace in decades. One hike, then another, then another. Mortgage rates doubled within a year. Tech companies laid off thousands. Housing demand cooled sharply. The Fed wasn't stimulating anymore. It was restricting. And here's the irony. To fix inflation, the Fed had to slow the economy, which means higher unemployment risk. That's the trade-off. Inflation is politically toxic. Voters feel it immediately. Groceries, gas, rent. Every trip to the store becomes a reminder. So when inflation surged, pressure mounted. Critics argued the Fed waited too long, that it misjudged inflation as temporary. Supporters argued the pandemic was unprecedented, that early tightening would have risked derailing recovery. Both arguments have merit, but timing is everything in monetary policy, and the Fed operates with imperfect data. It's steering a $25 trillion economy using lagging indicators. By the time inflation is visible, it's already embedded. This is the real debate. Could the Fed have prevented the 2022 inflation spike? Possibly by tightening earlier, raising rates in 2021, ending asset purchases sooner. But that would have risked slowing the recovery. Remember, unemployment was still elevated. The labor market wasn't fully healed. There's no risk-free path. Monetary policy is always about trade-offs. Stabilize growth too aggressively, inflation risk. Fight inflation too aggressively, recession risk. There's no perfect balance, only probabilities. So did the Fed cause inflation? Not alone, but it played a role. It amplified demand during a fragile supply environment. It maintained ultra-loose conditions longer than ideal. It underestimated persistence. But here's the thing. The same aggressive policies also prevented a potential depression in 2020. Without intervention, unemployment could have surged dramatically. Financial markets could have collapsed deeper. So the Fed's policies both prevented disaster and contributed to later instability. That's the paradox. Monetary policy fixes one problem by risking another. Here's the deeper takeaway. The Federal Reserve doesn't control the economy perfectly. It influences it. It adjusts liquidity. It shapes expectations. It manages interest rates. But it operates in uncertainty. And every major intervention has unintended consequences. In 2020, the priority was survival. In 2022, the priority became stability. Different problems, different tools, same institution. So when you hear someone say, the Fed caused inflation, the honest answer is more complicated. It didn't act alone, but its policies mattered. And in a world where liquidity drives markets, every trillion-dollar decision leaves a mark. The next crisis will come. It always does. And when it does, the Fed will act again. The only question is, will the cure once again create the next side effect? Because in modern economies built on credit, stability and instability are often separated by a single policy decision, and that decision is usually made at the Federal Reserve.